Welcome to BFSI classes, Domain Mutual Fund Agent, Module 3, Market and Sell Mutual Funds, Chapter 2, Scheme Selection for a Client. After studying this module, you will be able to explain how to help clients select appropriate schemes. We are moving to the module in first. First topic is steps in selection of a scheme. We have three main steps in selecting a scheme. First one, decide scheme category. Second one, select a scheme within the category. Third one, select the right option within the scheme. Decide scheme category refers to a selection should be based on risk-return comparison. Before the selection, a financial planner should compare the risk and return trade-off of various funds. The second step, select a scheme within the category, refers to a selection should be based on analyzing various parameters like value system, loads, etc. Third step is select the right option within the scheme. It means that the selection ultimately will be based on return on a scheme. Rather than risk or any other factor, return from that scheme will be the final authority or final decision making. So we are looking the first step, decide scheme category. Decide scheme category can be by comparing risk-return trade-offs. The chart here depicts that the risk-return trade-offs of different schemes. As we look in the picture, as risk level goes higher, returns will go high. As risk level is low, returns will be low. There is an inverse trade-off between risk level and return. So the selection should be appropriate as per the return and risk trade-off. Now the second one is select a scheme within the category. As we said earlier, there are various parameters for selection scheme in the category. Those parameters are follows. First one, value system of AMC. An investor should select AMCs that have strong value systems. AMC refers to asset management company which holds all the assets of a mutual fund. Second parameter is experience of fund manager. It is very important that the more experience of a fund manager has a better return. The third one, fund age. Funds with long histories are preferred over funds with small track records. So selection should be based on histories or fund histories. Fourth parameter is scheme running expenses. The lower the expenses, the better will be the returns on schemes. Tracking error. Funds with lower tracking errors are preferred because error will affect the returns on that investment. Next one, regular income yield in portfolio. Investors should select or should look for schemes that have consistent income yield in their portfolios. Risk-adjusted returns and their rankings and ratings. Investors should look at risk-adjusted returns and their rankings from an expert. So expert opinions are needed for selecting these funds. And the final one is loads. Loads mean the expenses, the entry charges and exit charges. Schemes with lower loads are preferred for selection. Third one, select the right option within the scheme. There are two main criteria for selecting a scheme within the schemes. First one, investors' taxation. Second criteria is liquidity needs. Investors' taxation is important because we should choose a scheme with small rate of taxation. It will increase the importance of return, or it will increase the return on that scheme. Okay. The second criteria, liquidity needs, means we should choose a scheme with higher liquidity options. Liquidity means the ability to convert into cash in a faster mode. Next one, selection based on time horizon. Time horizon are classified into three: short term, medium term, and long term. One should select the most liquid fund to avoid risk of loss in a short term. The short term refers to period up to 5 years. In period up to 5 years, the investor should choose debt funds other than balanced and equity funds. In medium term, that means 5 to 10 years period, the investor can select mixed funds, stocks and bonds. That means choose balanced funds. Long term means the period above 10 years. In this period, an investor can select even risky funds because it covers the risk of loss over the time. So in this period, an investor could choose equity fund. And we are moving to the summary. We have studied 3 different steps: deciding a scheme, selecting a scheme, selecting the right option within the scheme. Okay, we have said that 3 time horizons: short term, what funds are choosing; medium term, what funds are to be chosen; and long term, what funds are to be chosen. Okay. Then we are winding up this session. We will meet in another session. Till then, thank you.